video, we will talk about the market's core algorithm, the Interbank Price Delivery Algorithm, which institutional players use to manipulate prices in a controlled algorithmic manner. Understanding how this algorithm functions and recognizing its behavior will give you insights into predicting future price movements and protect you from the traps that smart money sets. For retail traders, we'll also explain the 3 key market analysis tools from the IPDA perspective that every trader needs to master before sitting behind the chart. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel. Welcome back, traders. So let's get started. Before we jump into the 3 main market analysis tools that every trader needs to master, let's see what is the algorithm of the market. A specific algorithm drives major market movements, and smart money, including market makers, banks, and large financial institutions, uses it to manipulate the market in their favor. This algorithm is known as the Interbank Price Delivery Algorithm, IPDA. The Interbank Price Delivery Algorithm suggests that smart money manipulates prices in a controlled, algorithmic manner to seek liquidity, balance inefficiencies, and deliver prices efficiently within the interbank market. Understanding the algorithm's function and its behavior in the market will give you the edge in predicting price movement in the market. So, let's have a more detailed explanation of the Interbank Price Delivery Algorithm. IPDA efficiently delivers price to buyers and sellers in the marketplace, ensuring that price moves smoothly between buying and selling, offering prices in both directions. This is part of the broader efficiency paradigm within the algorithm's logic, where the market constantly shifts between buying and selling to maintain balance. There are 2 main ways IPDA achieves this: rebalancing inefficient price action and seeking liquidity. Now, let's see what these terms mean in detail. The first way that IPDA operates is by rebalancing inefficient price action. As you can see, we have an inefficient price action created by this large bearish candle because of the lack of buy orders in that specific area, and time the price moved with great sell-side momentum to offer any buy-side delivery. This is known as sell-side price displacement. IPDA offers buy-side delivery to fill out and rebalance this sell-side inefficient delivery. The algorithm frequently creates inefficient price action and disequilibrium in the market, where prices move in an unbalanced way. Then, market will work to rebalance these inefficiencies by returning to those areas, filling the gaps and restoring equilibrium. This constant cycle of imbalance and rebalancing is a key part of how the market moves, offering opportunities for traders who can identify these inefficiencies and anticipate the rebalancing process. The second method is seeking liquidity, known as the pairing of orders. So here we have an example to explain how an algorithm seeks liquidity in the market. So here, as you can see, price has created a range, and we have great sell-side and buy-side liquidity below and above this range, generated by numerous buy stops and sell stops orders. We can see that the price moved sideways within the range until the algorithm started manipulating the market by pushing the price outside. This often happens during a news event or the opening of a session. When buy stops are triggered, the market experiences a surge in buying interest, causing a bullish wave. After activating the buy stops, the algorithm changes direction, pushing the price downward and distributing those buy stops toward the sell stops below the range. Once the price sweeps the sell side liquidity, the sell stops below the range pair with buy orders and pushes upward toward the buy stops above the latest swing high. Then, the buy stops above that high pair with sell orders and are distributed back down to the sell stops. The algorithm repeats this cycle over and over, constantly engineering and generating liquidity in the market. It does this to make manipulation easier, absorb more liquidity, and fulfill large institutional orders. Understanding how this algorithm works will help you protect your assets in the market. Here's how traders use IPDA to do that. Identify zones where institutional traders are likely to take action. Anticipate liquidity grabs around key levels, like support and resistance. Spot manipulation patterns, especially during session openings or big news events. Wait for inefficiencies to be filled as part of price delivery. So we fully discussed the Interbank Price Delivery Algorithm. And now, understand the main algorithm that drives the market. In the next part of this video, we'll explore the essential and basic concepts related to inefficient price delivery. These concepts are crucial for mastering and understanding the Interbank Price Delivery Algorithm. Now, let's start with the fair value gap, the most commonly used and straightforward tool. In the IPDA, the fair value gap forms on the chart. When we have inefficient price delivery, this happens when the price moves quickly in one direction only. This inefficient delivery of price leaves behind liquidity, voids, and unhealthy price action, which the algorithm will seek to rebalance and fill. Fair value gaps are typically formed within a 3-candle sequence and are easily noticeable on the chart. As a large candle, the distinguishing feature is that the upper and lower wicks of the neighboring candles do not completely overlap the body of the middle candle. This creates what we call the fair value gap zone, which essentially fills the space between the wicks and is drawn on the body of the middle candle. When the algorithm is in a hurry to reach a particular price point, smart money enters the market. It executes a large number of orders in a very short period, which causes an equilibrium between buying and selling orders. This results in displacements in price action in the form of the fair value gap. For example, when bullish fair value gaps form on the chart, the range between the candles that do not overlap indicates a lack of sellers as much as buyers. In other words, there were not enough orders to fill the executed by orders in that specific price level, resulting in unfilled by orders left in that area. Conversely, when a bearish fair value gap forms on the chart, it means there were not enough buy orders to fill the sell orders at that specific time, leaving unfilled sell orders in that area. These unfilled orders are the main prices return to these zones and often react and reverse in the opposite direction. From the IPDA perspective, fair value gaps are categorized into 2 separate models. The first one is the BC. BC refers to a market condition characterized by a buy-side imbalance and sell-side inefficiency. In this scenario, price offers only buy-side delivery in one direction. The algorithm pushes price far too quickly to offer any sell-side delivery and to find more liquidity to consume enough supply and rebalance the recently generated demand. This leads to a fair value gap known as BC. The algorithm will seek to rebalance the inefficiency by offering sell-side delivery, such as forming this bearish candle, to offer fair value for sellers to enter the market and create efficient price action. The next type of fair value gap, the bearish one, is known as CBE, which represents sell-side imbalance, side inefficiency. This is also similar to B, C, but in reverse. In a CB scenario, the price moves sharply downwards without enough buy orders to balance the movement, creating an imbalance. The algorithm then works to correct this by offering buy-side delivery to fill in the sell-side inefficiency, just as it does with buy-side inefficiency. Before we continue, if you're looking for a platform that keeps you updated with financial news and fundamental analysis, we recommend Fastball, one of the leading trading websites, offering unique tools to keep you ahead of the market. Fastball provides an accurate economic calendar, real-time market data, and a 24/7 trading question and answer service that allows you to receive expert opinions and analysis, helping you sharpen your strategies with professional insights. Additionally, Fastball has recently launched an exciting trading contest, offering incredible prizes for the winners. So if you're interested in participating in this exciting contest and benefiting from powerful trading tools, check out the link in the description. There are 3 key levels inside the fair value gap that are important to us. We have premium and high discount low and the midpoint, which is called consequent encroachment. Consider that each level also offers strong support or resistance levels in the lower time frame. Now let's move on to the next concept, mitigation block. A mitigation block is an array referred to in IPDA, price manipulation logic. It refers to a specific area on a price chart where institutional traders or smart money have previously placed orders, leading to a price imbalance or sharp move. The algorithm will refer to this area to allow interbank level traders to mitigate their long or short positions in the market. The main purpose of a mitigation block is to mitigate or revisit this area to fill any unexecuted or pending orders that were left behind during the initial move. In a bearish scenario, a mitigation block is identified by locating the last down, close candle or series of successive selling candles that form before an impulsive bullish expansion that fails to create a new higher high. This area represents a bearish mitigation block. The key characteristics to look for are bullish expansion move. The price moves upward, but fails to create a higher high, forming a lower high instead. Immediate reversal. After the bullish expansion move, price should reverse and break below the low of the mitigation block. And the exact opposite happens in the bullish scenario. Now, let's look at an example of a bearish mitigation block. Imagine the market is in a downtrend. To identify a valid bearish mitigation block, the first step is to look for a swing high to form. Next, we need to see a swing low. After this, the price must create a lower high with an impulsive bullish expansion. What we need to see next is an immediate reversal, followed by a market structure shift that breaks and closes below the latest swing low. At this point, the last selling candles formed before the bullish expansion represent the bearish mitigation block. Eventually, we see the price tap into the mitigation block again, adding even more orders into the market. And then the price moves lower with strong momentum. Now let's move on to the next concept. Order block. Order blocks are zones on price charts where the highest volume is traded. They are known as decisional areas that form before institutional orders are executed in the market. Usually price returns to these zones and often reacts and reverses in the opposite direction. In a bullish scenario, a candlestick-based order block refers to the last selling candle before the price starts pushing upward drastically. This candle typically breaks below or effectively sweeps the liquidity of the lowest point of the previous candle. For example, in the bullish diagram, we identify this red candle as a valid order block. It serves as the last bearish candle before the price initiates a drastic upward movement, having taken out the lowest point of the bearish candle and effectively swept its liquidity. Similarly, in a bearish scenario, a candlestick-based order block refers to the last buying candle before the price starts pushing downside drastically. This candle typically breaks below or effectively sweeps the liquidity of the highest point of the previous candle. Please note that IPDA will refer back to order mitigate blocks and to add positions. Now let's see some of the most fundamental criteria and rules that we need to consider to identify valid order blocks. To have a confirmed and valid order block, first, the price must remove and sweep the liquidity above or below the previous candle to form a valid order block. Secondly, price must leave inefficiency behind and generate imbalance near the order block area. If there is no proper imbalance between the subsequent candles, then the identified order block cannot be considered valid. To solidify our understanding of order blocks, let's examine more examples. Consider a series of bullish candles as illustrated. As you can see, the market momentum was bearish until the price created this week bullish candle just before starting to push upward with these three large green candles. This week bullish candle reached its lowest point here, and additionally it took out and effectively swept the liquidity below the previous candle. As mentioned earlier, our identified order block cannot be considered valid without a proper imbalance in the subsequent candles that form after the order block. If we look at this three-candle sequence, we see that the upper wick of the first candle and the lower wick of the third candle do not overlap the whole body of the middle candle. Here we have a gap between the candles, representing the imbalance, since the criteria for a valid order block are met here. This candle represents a valid order block. If we look a bit higher, we see that the price has created a drastic upward movement once again. This red candle represents the last bearish candle that had just been formed before the price started to push drastically to the upside. We can see that this bearish candle has taken out and effectively swept the liquidity below the previous bearish candle. since the price has also created a proper gap between these three sequential candles, meeting all the criteria for identifying a order block. We can now consider this candle as a valid order block with the potential to reverse the price if it pulls back down and mitigates it. As you can see, this bearish candle here is the last bearish candle before the price formed another bullish movement. However, this candle does not represent a valid order block because it did not take out the previous candle's low. Let's examine more examples. Consider another series of candles as illustrated in the second diagram. Once again, we see that the price has taken the previous candle low, effectively sweeping liquidity below it with this bearish inverted hammer candle. Thus, we have a potential candidate for a valid order block. However, there is no noticeable imbalance among these three candles, and the upper wick of the bullish candle mitigates the order block. Consequently, this order block cannot be considered valid, as it fails to meet most of the necessary criteria for validating an order block. Therefore, it cannot be utilized as a demand zone. When faced with scenarios like this, where the price has taken out the liquidity from the previous candle, but the order block is mitigated, or when the price fails to create an efficiency, we designate the subsequent candlestick as the valid order block. In this case, we identify this bullish candle as the valid order block instead of the previous selling candle. This decision is based on the fact that the generated a proper inefficiency or imbalance immediately following the bullish candle. If we look slightly higher, we notice that the price has taken the previous candle's low, effectively sweeping liquidity below it with this bullish candle before the price starts to push significantly higher. However, there is no discernible imbalance, and the upper candles wick mitigates this order block. Therefore, this order block cannot be regarded as valid and cannot be utilized as a demand area. Once again, the price has significantly pushed to the upside. This red candle represents the latest bearish candle that has just formed before the price started to push dramatically higher. Evidently, this bearish candle has surpassed and effectively swept the liquidity below the previous bullish candle, as the price has created a proper gap between these three sequential candles, and there is no mitigation. All the criteria for identifying a valid order block have been met. Consequently, we can now regard this candle as a valid order block. That's